My name is David Sandalow. I am the inaugural fellow at the new Center for Global Energy Policy here at Columbia. This has been quite a first year for the Center on Global Energy Policy. It's almost reached its first anniversary. And in this year, under Jason Bordoff's leadership, it's really been an explosion of events like this with some high-profile speakers, people like U.S. Energy Secretary Ernie Moniz, General Stanley McChrystal, a whole range of exciting speakers come to talk about the most important energy issues of the day. And a variety of research projects underway on topics as diverse as U.S. exports and China shale gas and the future of the utility grid, and a number of other topics. We're particularly delighted to have here today a person who I consider to be one of the leading thinkers in the country on energy economics and China, where we've worked together. But before I introduce him, let me just say to those who are listening by our live web stream that we're taking questions on the hashtag CGEP events, CGEP EVNTS, which is also displayed on it should be displayed on your live stream view. So if you want to send us questions, please send it, and I'll be looking at my mobile device and getting questions throughout the course of the event. But we're particularly delighted to have Trevor Houser here to talk about his new book, Fueling Up. Trevor's a partner at the Rhodium Group, where he heads the firm's energy and natural resources work. He's also a visiting fellow at the Peterson Institute for International Economics. He's written widely on energy economics in China, including more than a half dozen books and monographs. We had the pleasure of working closely together in 2009 when I was at the U.S. Energy Department. Trevor was an advisor at the U.S. Department of State, and I can say he played a central role in some of our work on U.S.-China energy relations, including negotiating agreements on a number of topics, including actually the U.S.-China Clean Energy Research Center, which now has more than 1,000 researchers working at it. As I said, he is one of the smartest analysts in this area around, and I can tell you that when Trevor Houser talks, people in Washington, where I've spent much of the last 20 years of my career, listen, and you're about to understand why. Trevor.
Thanks very much for that embarrassing introduction. I'm sure you're wondering how that description matches with the 13-year-old kid that you see standing before you today. The key to that is not getting any higher education. You have to get started and work early. There are, many people in Washington who owe whatever modest professional success they've had to David Sandalow, and I'm happy to count myself among those, as he helped pluck me from, the trenches of Chinese coal mine obscurity in 2009, and gave me a chance to help the team at DOE and State work on U.S.-China issues, which was a fantastic experience. So the book that has been several years in the making by myself and my co-author Shashank Mohan seeks to try to quantify the economic impact of the transformation in the U.S. crude oil and natural gas landscape that we're seeing today. We're not trying to forecast any particular natural gas or oil production future, but we're trying to look at what the range of current production forecasts would mean for the rate of economic growth, for employment, for industrial competitiveness, for the environment, and for U.S. trade policy. And so I'm going to walk through some of the key findings here today, but there's a lot of meat and wonky charts in the book, and you can be the 16th or 17th person to read it if you rush to Amazon now to buy it. So just as a scene setter, because we've gone through such a dramatic turnaround over the past few years, it's useful to remember what our energy picture, our oil and natural gas picture in particular, looked like just 6-7 years ago. In 2006, 2007, U.S. crude oil prices and natural gas prices reached their highest level since we began keeping track, which for crude oil was in the late 1860s. Adjusted for inflation, over the last decade, we have paid more per barrel or per MMBTU in the case of natural gas for energy than we have ever. And in 2005, 2006, 2007, the outlook for that changing anytime soon was pretty bleak. Projections for U.S. oil and natural gas production from folks like the Energy Information Administration in D.C. or the International Energy Agency in Paris were fairly grim, either constant or declining energy production in the U.S., increased dependence on Middle East as a source of energy supply, and rising costs. So dire was the outlook that it prompted a Texas oil man turned president to claim that there was no alternative but to end our addiction to petroleum and move to a post-petroleum economy. As President Bush was giving that speech, the State of the Union address in 2006, back in his home state of Texas, that dramatic run-up in prices was catalyzing a transformation in the way that we produce oil and natural gas in this country. There's the old economist joke that the cure for high prices is high prices, and that proved true for U.S. natural gas production. Through a combination of three innovations: hydraulic fracturing, horizontal drilling, and seismic imaging, oil and natural gas companies in the first instance, were able to unlock resources from formations that were previously deemed commercially inaccessible. Those technologies have been combined for years, as early as the 1980s. It wasn't until prices started to rise that there was enough capital attracted to Texas and other parts of the country to really result in a significant growth in hydraulic fracturing and natural gas flows. But that growth did occur and was dramatic. Between 2007 and 2012, U.S. natural gas production rose by 30%, and the forecasts for future natural gas production were dramatically revised. So this shows you the annual production forecast for natural gas from the Energy Information Administration, and the revision between 2006 and the 2014 forecast is twice as large as total Asian natural gas consumption combined. So a fundamental change in the outlook for U.S. natural gas production. Current private sector forecasts and other government agency forecasts for natural gas production vary a bit, but are all fairly optimistic right now in the kind of pace of growth and the duration of growth in U.S. natural gas supply. That 30% growth in U.S. natural gas output led to a sharp decline in U.S. natural gas prices. Traditionally, crude oil and natural gas have cost about the same on an energy basis. As a result of fracking and the increased supply that brought about, natural gas prices collapsed from a high of $15 per MMBTU down to a low of $2 per MMBTU in April of 2012. Meanwhile, crude oil prices stayed relatively high, and an unprecedented spread between oil and natural gas prices emerged. That provided a pretty powerful commercial incentive for arbitrage, and it turns out that same combination of horizontal drilling, hydraulic fracturing, and seismic imaging that was used to unlock gas from shale formations could be used to unlock crude oil from either shale or other tight, low permeability formations. So we saw a redirection of industry focus and drilling activity away from gas-rich shales like the Barnett and the Haynesville shale towards liquids-rich shales like the Bakken and the Eagle Ford. If you go back 4 or 5 years, 75% of all rigs in the country were drilling for natural gas. Today, 75% of all rigs in the country are drilling for oil, but they're still using that combination of hydraulic fracturing and horizontal drilling. And just as in gas, that drilling activity resulted in a pretty sharp increase in U.S. crude oil production. U.S. crude oil production grew by 1.5 million barrels a day between 2007 and 2012, by another million barrels a day in 2013. And the growth in production of a crude-like substance called natural gas liquids that comes from shale formations added another million barrels a day to total U.S. liquids supply. So reversing a 3-decade decline in U.S. liquids production. And it's resulted in an even more dramatic revision in the forecast for future U.S. Oil supply from the EIA and from other organizations. Now, there's much more uncertainty about the future rate of growth and magnitude of U.S. crude oil production than for natural gas. That's both because the resource is newer. We're still learning what the decline rates look like, what the cost of production is, but more importantly, because the natural gas market is regional, it's a North American market, and the oil market is global, and the future of U.S. crude oil production will depend as much on what other producers elsewhere in the world do in response, like OPEC, as what the cost of production is in the U.S. And you can see that variation in the range of current crude oil production forecasts from industry sources and government entities. So given how uncertain that outlook is, what we did is modeled a conservative production pathway that kind of paints the bottom end of those private sector scenarios and an optimistic production pathway. And we compared that to what we call a pre-shale scenario, which is where we keep everything else constant, all the economic assumptions, but we change the resource base back to where it was in 2007, so that we can isolate the economic impact just of that change in resource supply over the past 5 years and get a sense of just how big of a deal it is and how is it going to impact the economy. All right. There we go. So to date, the most significant economic impact of the shale boom has been the oil price future that it helped us avoid. So between first half of 2008 and the first half of 2013, the U.S. added about 3 million barrels a day of liquids production to the global market at a time when European production was declining by 1.5 million barrels a day. We took 1.5 million barrels a day of Iranian exports off the market due to sanctions. If that increase in U.S. oil production had not occurred, oil prices would have been considerably higher over the past 5 years, and at a point where the global economy was struggling to emerge from the financial crisis and would have had a hard time dealing with significantly higher prices. It's difficult to say just how much higher, but they would have been considerably higher, and decent odds that could have brought about a double-dip recession, at least here in the U.S. Going forward, the reduction in energy prices continues to be the most important economic benefit of the shale boom. So if we compare our optimistic scenario to our pre-shale scenario, we see a reduction in annual average consumer energy expenditures over the next 20 years of about $180 billion a year. That's both for households and for businesses and for government consumers of energy. And as U.S. production is displacing imports, even though overall energy expenditures are going down, U.S. producer revenue is going up by about $60 billion a year on average. Now, interestingly, most of that is concentrated on the oil side. Natural gas producers today are making less money than they did before the shale boom because the increase in volume hasn't been enough to compensate for the decrease in price. Right? That's been great for consumers, but it hasn't been good for producers. There's a reason why there's an OPEC in the oil market, because there's a level of production that is optimal for producers that might not be optimal for consumers. There's no OPEC in the U.S. natural gas market. It's a highly competitive market. And so we've seen prices fall to a level that is not great if you're in the natural gas business. Second most important economic impact is the increase in investment. Oil and gas is a investment-intensive industry. This slide shows total fixed asset investment by industry in 2011. And in our analysis, in the optimistic scenario, there's about $100 billion a year of additional upstream, midstream, and downstream investment relative to the pre-shale scenario in the oil and gas sector. Now, in the short term, by which I mean, next 5 years, that combination of increased investment and lower energy prices acts as a fairly powerful economic stimulus at a point where our economy is below full employment, where there's capital and labor on the sidelines. It acts on the economy in a very similar manner to the way the Recovery Act did in 2009, which provided a tax cut, kind of like an energy cost reduction, with infrastructure investment, kind of like the fixed asset investment in oil and gas that we see today. And in our analysis, the magnitude of the oil and gas boom between 2013 and 2020, which in our modeling is when the economy is back to full employment because we're pessimists, is on par with the magnitude of the Recovery Act between 2009 and 2013. A 20 to 30 basis point increase in the annual rate of growth, so 0.2, 0.3% faster growth each year, and a 2% increase in the level of GDP by 2020. We're in a position where any 20 to 30 basis points of growth that we can get is great. We'll take it. Over the long term, however, the economic benefits are much more modest. As the economy returns to full employment, that investment in oil and gas production will increasingly come at the expense of investment in other parts of the economy. Employment in the oil and gas industry will come increasingly at the expense of employment in other parts of the economy. Equilibrium effects will start to take hold. In that way, we don't see the oil and gas boom as being the kind of transformative event for the economy that the IT revolution was, against which the oil and gas boom is often compared. The IT revolution was transformative not because of an increase in output of hardware and software. It's not because we sold more Dell computers. It was the broader productivity improvements that the application of that IT enabled, right? Whether I was in finance or logistics or hair salons, by buying computers and using them in my business, I was able to do things more productively, more efficiently, and reduce costs across the economy. Energy has done that in the past. When we went from wood to coal in the late 1800s, coal was a more useful form of energy. There's a bunch of stuff you can do with coal that you can't do with wood. The Industrial Revolution wouldn't have been possible if we were a wood-based economy. Likewise, when we went from coal to electricity, there are things you can do with electricity that you can't do with coal. Electricity is more useful as a form of energy. What we're talking about today is not a newer, more useful form of energy. It's the same energy, it's just cheaper. Now, that's economically beneficial, but it's a one-time shift in the potential rate, the potential economic output of the country, not a sustained increase in the rate of economic growth. Those types of sustained increases in the rate of economic growth, you only get through, fundamental demographic changes like greater labor force participation, as occurred when women entered the labor force in the U.S., or economy-wide technological transformation that increases productivity throughout the economy. It will, however, change the composition of the economy in very important ways. There's a narrative that has emerged that the oil and gas boom will lead to an industrial renaissance, a manufacturing renaissance in the U.S. If we simultaneously in this country experience a natural resource boom and a manufacturing renaissance, that'll be one of the first times in human history those two things have occurred together. Generally, the opposite occurs. Countries that have experienced natural resource booms generally see those sectors draw capital and labor away from their manufacturing sector, that the increase in export of natural resources pushes up the value of their currency and makes their tradable goods sector, their manufactured goods sector, less competitive. So we saw that in Australia and in Canada over the past decade, and Brazil as well. As their trade surplus in natural resources increased, they saw an almost commensurate decline in their manufactured good trade balance because of appreciation of their currency. So if you go to Sao Paulo today and you talk to the Labor Federation, their public enemy number one is not Chinese manufacturers, it's Vale, the iron ore company in Brazil, because Brazilian iron ore exports push up the value of the real and create headwinds for Brazilian manufacturers. Now, there's a lot of reasons why the U.S. could be different than those cases. First, the scale of our resource boom in context of the overall U.S. economy is much smaller than the Brazilian, Australian, or Canadian resource booms. Even if we become the world's largest oil producer by 2020, which we may overtake Saudi Arabia by 2020, oil will still be a relatively small part of our economy, certainly compared to Saudi Arabia. Also, there's been a disconnect in energy prices between the U.S. and some of our main manufacturing competitors that some think might offset the headwinds that you would otherwise experience from a more expensive dollar from exchange rate appreciation and make some manufacturing more competitive. So, for example, in natural gas, where we've seen the biggest dislocation between U.S. prices and international prices. In 2005, U.S. industry paid about as much for natural gas as European industry, Japanese industry, or Chinese industry. By 2011, U.S. industry was paying half this price of competitors in Japan, competitors in Europe or China, and a third of the price of competitors in Japan. So what we do to try to get a sense of how beneficial that reduction in energy price will be, and for what manufacturing industries, we take a survey put out by the Department of Energy called the Manufacturing Energy Consumption Survey, which tells you how much coal, oil, gas, electricity, renewables, 440 different industries in the U.S. consume. And we map through the change in energy prices between our optimistic and our pre-shale scenario to get a sense of what the change in production costs would be. And for some industries, it's a big deal, like the chemicals industry, which we've seen in chemicals company profitability and pricing over the past few years. So U.S. chemicals companies, petrochemicals companies, largely use a natural gas derivative called ethane as feedstock, as opposed to competitors in Asia or in Europe that use a crude oil derivative called naphtha. As the price of natural gas has fallen in the U.S., the price of ethane has fallen alongside it, and U.S. chemicals companies are much more profitable today than many of their competitors in Asia and in Europe. And there are a number of other industries for which the reduction in energy costs will be material: fertilizer, some types of metals manufacturing, flat glass. But when you put those industries in the context of U.S. manufacturing as a whole, industries that could see a greater than 10% reduction in their total production costs as a result of the shale boom account for only 1.3% of U.S. manufacturing. The vast majority of U.S. manufacturing is not energy intensive. Making automobiles, airplanes, electronics, machinery, energy is maybe 1 to 2% of total production costs. And for many of those industries, a more expensive dollar would be far more detrimental to their health than slightly cheaper energy. So if I was to go to Everett, Washington, where Boeings are made, and give Boeing the choice of free energy or a 5% depreciation of the dollar vis-a-vis the euro, which Airbuses are sold in, I bet you that they would take the 5% depreciation of the dollar. So what we did is we mapped out by industry the potential change in energy cost savings as a share shipment value, that's on the x-axis, versus a concept called net export orientation. It's a measure that the Fed uses to assess the vulnerability of an industry to exchange rate appreciation. So higher you are on the y-axis, the more vulnerable you are to exchange rate appreciation. And as you can see, for chemicals, clearly the outlier. This is a big, big deal. The reduction in energy cost more than offsets the appreciation of the dollar that you could see as a result of the boom. But for computers and electronics, machinery, electronic equipment, cars, trucks, there's potentially more downside risk than there is upside gain. That's the theory. What we've seen in the trade data over the past couple years would suggest that that theory is holding up. While our overall trade deficit has declined, thanks largely to a decline in our energy trade balance, our manufacturing trade deficit is actually growing. Manufacturing, industrial production in the U.S. is outpacing European industrial production, but that's just because the economy is growing faster here. There's more demand. Our manufacturing trade balance is lagging behind Europe's. Europe is outperforming us in terms of their international manufacturing trade position today. In part, that's because there's not a lot of demand in Europe, so there's lots of European industrial production available for other people to buy. But that's about what you would expect to occur given theory. Let me walk through some of the environmental effects. We'll talk about the trade policy consequences briefly, and then turn it open to discussion. In the same way that the shale boom is altering the composition of the U.S. economy, it is altering our environmental landscape as well. When as David mentioned, I worked at the State Department in 2009 and had the opportunity or misfortune to serve as a climate negotiator in Copenhagen. And if you had told me in Copenhagen that we would be standing here in 2012 and U.S. CO2 emissions would be 12% below their 2005 levels, I would have danced a jig. And the fact that that would have happened despite the failure of the U.S. Senate to pass cap-and-trade legislation would have seemed beyond the pale. This chart shows you projected CO2 emissions from the EIA in 2006 versus actual CO2 emissions. Emissions in the U.S. have declined faster over the past few years than they have in Europe, where there is an economy-wide cap-and-trade system. Now, it turns out that the majority of that decline in emissions has happened for reasons that we shouldn't necessarily be celebrating, primarily the financial crisis. And indeed, that's why those two lines look pretty close, because we're both part of the same global economy. The decline, slowdown in economic growth, over the past 5 years accounts for about 2/3 of the reduction in U.S. CO2 emissions that we've seen. But the other third is from efficiency and, more importantly, from a reduction in the carbon intensity of energy supply. Renewables have played an important role but over the past few years, natural gas has played a major role. As natural gas prices have gone down, we've seen large-scale switching from coal to natural gas in the electric power sector. During April of 2012, when gas prices bottomed out at a little under $2 per MMBTU, we were generating as much electricity from natural gas as coal, which was the first time in a long time that that's happened in the U.S. We have, however, seen about as much reduction in CO2 emissions from cheap natural gas as we are likely to see. As gas prices rose throughout 2012 and through 2013, coal's share of power generation rose as well. And it's up from 33% now up to 41, 42%. U.S. CO2 emissions probably grew by 1.5% last year, and they'll probably grow by another 1.5% this year, absent new policy. So the shale boom is neither environmental peril for the U.S. and it's not environmental salvation. But what it does do is change the cost and the politics of environmental regulation, particularly climate policy, in some interesting ways. So these two charts compare projected U.S. power generation by source in our pre-shale scenario and in our optimistic scenario with a carbon price. So in the pre-shale scenario, and this is kind of the world as it looked in 2008 as we were debating cap and trade legislation, putting a price on carbon would lead to a gradual decline in coal consumption, installation of carbon capture and sequestration, fairly rapid build-out in nuclear and renewables. Today, you impose that same policy with the current gas prices, and you would see a very large-scale switch in coal generation to gas generation. So still some modest growth in renewables, but almost no growth in nuclear generation. Low-cost natural gas provides a very large-scale, low-cost abatement opportunity in the U.S., at least for the next decade and a half. After that, if you want to continue to drive down emissions, you either have to equip that natural gas with CCS or you have to switch to nuclear or renewables. Why that's interesting to me is that it changes the regional cash-in, cash-out of environmental policy, right? The kind of political dynamics around cap and trade in 2007, 2008 was you had coal-producing states that were going to lose, you had coal-consuming states that were going to see a lot higher electricity prices, and the winners, the guys who'd be making the renewables and nuclear power, either weren't born, you didn't know if that stuff was going to be made in the U.S., they weren't powerful constituencies. Today, if the primary technology solution is a switch from coal to natural gas, that translates into in our analysis, $20 billion a year increase in natural gas production revenue that's concentrated in places that have not previously been terribly supportive of climate policy, like Texas and Oklahoma and Arkansas. Now, that change in states' interests and the economics of policy doesn't necessarily translate into a change in politics, but the fundamental economics of climate policy at a state and regional level are very different now than they've been before. The forthcoming EPA regulations on existing power plants could very well be outside of the polar vortex, one of the largest giveaways to the U.S. natural gas industry that we've seen in a long time. All right, trade policy implications. The change in the U.S. energy picture has international ramifications. The U.S. was, until very recently, projected to become the largest LNG importer in the world. We have completely stepped back from the natural gas import market and are on the cusp of becoming a very large natural gas exporter. There are permits that have been approved by the U.S. Department of Energy for 8 to 10 BCF a day of LNG exports by, let's say, 2020, 2025. That'll make us a major player in international LNG markets. That pullback of the U.S. as an importer and the entrance of the U.S. in the market as an exporter is increasing Japanese customers' negotiating leverage with LNG suppliers elsewhere in the world, is allowing European utilities to renegotiate contracts with Gazprom, has some fairly significant geopolitical implications. We had a debate around LNG exports that got fairly intense a few years ago. The Department of Energy has been approving terminals, and so that debate is on a simmer for now. The energy trade policy debate of this year will be crude oil exports. That's already flared up as a prominent trade policy issue. It turns out that we have a ban on crude oil exports in this country. Nobody really noticed because we haven't tried to export crude oil for a long time. Even though the U.S. still imports 7 million barrels a day of crude oil comes in different flavors, and the type of crude oil that we produce is not necessarily well suited for the type of refineries that we've built in this country, and so companies are looking to export crude oil. Currently, you have to get a presidential waiver to export crude oil anywhere other than Canada, and the ability to modify or change that regulation will be a major feature of the policy debate this year. And then the third energy trade policy issue lurking in the ranks is coal exports. As cheap natural gas has displaced coal and U.S. power generation, U.S. coal producers are increasingly looking overseas for markets for their coal. Currently, you can export coal from the East Coast, from the Gulf of Mexico, but Central Appalachian coal, the coal that's exported from the East Coast, is structurally high cost and is only really competitive in years where demand is very high elsewhere. There's supply disruptions. Coal in my home state of Wyoming is extremely cheap, and you can mine it all day long. And in recent years, the profitability of that coal in Asia has increased fairly dramatically as long as you can actually get it to market. And there does not exist right now the terminal capacity to export that coal. There are companies proposing to build somewhere between 100 and 120 million tons of coal export capacity on the West Coast, and that'll be a considerable fight as well as folks try to grapple with what the environmental implications, the market implications of exporting coal would be. So for those of us who, have done a lot of trade policy work in the past, this is, great grist for the mill for the next few years. Lots of fun stuff to analyze on the trade policy implications of the turnaround in the U.S. Energy picture. So that's, I think, enough food for thought to get us started. I wanted to leave a nice, healthy hour for discussion.
Trevor, that was tremendous. It's filled with insights, and I suspect there are a number of questions. But let me just get started. And do we have a microphone? We've got some people to come up or pass it around. Great. So if you want to ask a question, why don't you come up to the microphone?
If you could please state your name and affiliation when you come up.
Let me just get started and say there are a number of provocative and very interesting observations in what you said. And I was particularly struck by your comments on the manufacturing sector in the United States and Dutch sniffle, as you called it. Can you just, I'm particularly struck by it because it's somewhat different than the public narrative that's out there on this. And I wonder, can you just kind of place your analysis along a spectrum of other analyses that have been done on this, or kind of other analysts coming up with the same type of results, do you think, or is yours an outlier? How would you describe it?
So I would categorize, there's analysis that's been done by the oil and gas industry or by people who are primarily energy analysts, and then there's analysis that's been done by macroeconomists. I would say, by and large, the macroeconomists come to similar conclusions that I do. The energy analysts come to different conclusions, and I think that's actually understandable because the very part of the U.S. manufacturing complex that is benefiting happens to be co-located with the energy industry, right? So if you live in Houston, you feel like you're in the middle of a manufacturing renaissance. There's new ethane crackers being built all around you. There's new steel pipe manufacturing. The problem is when you pull back the lens and you put that in context, it's relatively small. And then there's also an attribution problem, right? So if I'm a chemicals company and I make a multi-billion-dollar investment in a new cracker, and I say that's because of cheap energy, that makes headlines, right? The reduction in competitiveness in non-energy intensive parts of the economy is distributed and gradual and non-attributable, right? So none of that makes headlines. So what you read in the press is all about the winners, but you're not going to read in the press the losers because they're buried in the macroeconomic gloss.
So the reduction in competitiveness you're talking about is driven in part by the currency impacts.
Correct.
And maybe I missed this, but what do you project the currency impacts of the oil and gas boom to have been so far? What's the impact on the dollar, and what could it be going forward?
So all else equal, the oil and gas boom could lead to up to a 7% appreciation in the dollar in our analysis.
Already has or could?
It could. So the challenge is that within the kind of symphony of things affecting the dollar, this is like the second violin, right, relative to QE3 and everything else that's determining the U.S. exchange rate. But if the goal is to try to isolate the shale boom in particular and see what is the impact of this directly on manufacturing competitiveness, then you want to look at both what's the direct impact on energy costs and what's the direct impact on the exchange rate, holding all else constant, right? Energy costs could get high for other reasons, like cold weather. The exchange rate can move for other reasons, like Eurozone collapse. But if you want to look at just the shale boom and think about how big of a story that is for manufacturing, the level of appreciation of the dollar that you would see from that directly would offset the gains for most parts of U.S. manufacturing.
And so here's a simple question from a non-economist like me. So we're not exporting this gas yet in any significant quantity, and we're not exporting the oil because of the ban. So the currency effects you're talking about are mainly driven by the reduction in imports?
That's right. Right.
Okay.
So an increase in exports, reduction in imports has the same macroeconomic effect.
Got it.
At the same magnitude.
Got it. Would you?
Yeah.
Please.
Jonathan Robbins, I'm a student at the business school. I had a question with regard to investment in renewables. I know you addressed the carbon impact of the oil and gas production. What does that mean for renewable production as gas prices became much cheaper? I mean, are you forecasting like a pretty massive decline in renewable investment, or is it going to hold steady?
I think to date the impact has been relatively modest because many of the policy supports for renewables are renewable specific. So you have renewable portfolio standards at a state level. Gas can't qualify for that. It has to be renewables. You have a production tax credit and investment tax credit that are targeted at renewables. The question is, if those policy incentives expire, how does low-cost natural gas affect the competitiveness of renewables? And I would say that it's going to be a meaningful impact for wind, a little bit less so for rooftop solar in terms of market competitiveness.
Dan Benkel, just an interested person. This may be the wrong question, but for the long term, in the 50-year effort, this wonderful increase in hydrocarbons and all the implications it has may have pretty disastrous implications for the final climate evolution on Earth. So what kind of policies do you think would be necessary to take advantage of this boom in the short term, but bend it so that we can in fact survive?
That's a great question. So for the U.S., there's debate about the level of methane leakage from oil and natural gas production, and methane is a greenhouse gas, a potent greenhouse gas. At the current EPA estimates of the level of methane leakage, the switch from coal to gas that we've seen in the power sector as a result of the shale boom has been a net positive for the climate. It's been much less of a net positive than often is attributed, but it's been a net positive. But like I said, that doesn't solve your climate problems. That to achieve anything like the atmospheric stabilization goals that the international community has set, you will need to either move away from all hydrocarbons and coal, or employ technologies like carbon capture and sequestration. The opportunity that I think this presents is both it gives us some economic headroom to put those types of policies in place, long-term climate policies in place, and it actually makes the cost, the short-term cost, which is what constituents generally care about, lower, and it makes some of the regional politics more attractive. Now, I don't necessarily think the policymakers are going to seize that opportunity, but that's, if I was emperor for a day, this provides us with a window of opportunity to do some things that will really help over the long term. I think the same is true on the economic side. We don't think that this is a transformative event for the U.S. economy over the long term. It does, however, create a window of opportunity to put in place some of the structural reforms to the U.S. economy that really would lead to sustained increases in the rates of economic growth. Tax code reform, education investments, innovation investments, infrastructure investments, right? Both because it gives us a little economic headroom, it gives us some increase in state resources through excise taxes on natural gas production. My concern is that the opposite is going to occur, that policymakers, rather than take this as an opportunity to make long-term investments in the economy, are going to sit back and say, we don't have to worry because our children all have a bright future in chemicals manufacturing. And if that is the policy response, then I think we're in bad shape.
I think you said that the reduction in emissions is less than is usually described, or
Yeah.
is that? Could you just elaborate on that?
Just from the shale boom, the reduction in emissions is less, and that's because it was a chart that I went through, but I didn't show. When people when people try to attribute the reduction in emissions from natural gas, they look directly at the switch from coal to gas in the power sector. They look at the carbon intensity of coal and the carbon intensity of gas, and then you add in whatever you think methane emissions are on top of that, right? But the shale boom, if that's the thing we're looking at, has made energy cheaper across the economy, which leads to greater levels of energy demand. And when you factor in that rebound effect, that actually erodes about half to 2/3 of the gain that you get just from fuel switching in the power sector. People talk about the rebound effect a lot in the context of energy efficiency, that if I mandate more efficient appliances, people will use their air conditioning more, and that'll offset some of the benefit. If that rebound effect occurs for efficiency appliances, it occurs for natural gas prices as well. If natural gas is cheaper, people are going to use more of it, not just in the electric power sector, but across the economy.
Interesting. Thanks.
Michael Bloom, formerly in the United Nations. Let me return to the question that our moderator brought up regarding the effect of the boom on U.S. foreign exchange. Two questions in that area. First, the Dutch disease, that's what it was first named after, and the examples you brought up of Canada and Australia, all three of those examples, the oil and gas sector were a much larger portion of the total economy. So won't that therefore have a much smaller effect on the U.S. foreign exchange? Second, U.S. foreign exchange is determined much more, or exchange rate is determined much more, I believe, by financial assets than by the trade account. There's, as you know, trillions of dollars in U.S. held by foreign governments. And, therefore, again, it would have a less effect than the examples that you brought up.
Sure, the magnitude is certainly different, and I think that's a point that I made. I mean, we're not the magnitude is different. I don't think the direction of change is different, though. I think that the same macroeconomic principles apply, that if our savings and investment balance is staying the same, then a decline in our competitiveness in one good, like oil, or an increase, in our competitiveness of one good, like oil, will lead to a decline in our competitiveness of another good, like manufacturing. Now, I think that the effects are modest, 5% appreciation of the dollar. I think the effects are modest in terms of the reduction in energy costs as well. So I don't think either of these things will be the primary determinant of the fate of U.S. manufacturing. But in terms of the direct impact of this boom, that's certainly the way the direction goes. I mean, think about it for a minute. You have, if as a stylized example, if we're going from buying 100% of our oil from Saudi Aramco to 100% of our oil from Pioneer, let's say, right? Those two companies are going to do very different things with their revenue, right? So the money we bought from Saudi Aramco had to get recycled into dollar assets somehow. That turned into net investment into the U.S., which all else equal puts upward demand on treasuries, right? If we instead buy 100% of our oil from Pioneer, and that gets distributed to the shareholders and the employees of Pioneer, that money is going to be spent in a different way. It's going to buy a different mix of assets, and that the net impact of that will be appreciation of the dollar of that change.
Marjorie Schaap, Damascus Citizens for Sustainability. I spoke with an expert on Sunday, and the methane, he told me, for a 10-year period is 125 times more potent than CO2. For a 20-year period, 86 times, and for a century, which I don't think we have, is 36 times more potent than CO2. And the other thing I remember reading in the New York Times is maybe our CO2 has decreased, but the methane or the CO2 has increased in developing countries, and we do share the air with the earth. So have you done any real cost pricing of the effects of climate change due to the highly potent effect of methane? And number two, have you figured in the EROEI in getting the fossil fuel, the oil and the gas? And have you figured in the decline rates, which means you're going to have to be drilling more wells, and this is what people in your industry is saying, and in figuring out how will this boom continue when you have higher methane rates and steep decline rates, which mean more wells and higher costs in drilling those wells. So how do we overcome that?
So for your first question, we factored in analyzing what the net climate impact of the shale boom has been in the U.S., we factor in methane at its global warming potential using the factors from the Environmental Protection Agency and using the leakage rates from the Environmental Protection Agency. Now, it is possible we have limited direct measurement of leakage rates. Environmental Defense Fund and other organizations are conducting direct measurement to try to give us a better sense of what leakage rates are. And if they turn out to be higher than the rates estimated by the EPA, then that will change. That'll change the math. But we're factoring that in at the current EPA, at the EPA rates. On your second question, we don't really have a point of view of what the sustainability of, as I said in the beginning, of the current rates of U.S. production growth are. That's why we took a scenario approach where we bookended the most conservative current forecast for U.S. production, the most optimistic. And I feel pretty confident that reality is somewhere in between our two bookends.
Jinchao Wu, CFA student. So the IEA published a data last month showing that the oil demand growth in 2013 in the United States is actually larger than that of China. And that happened for the first time since the last 13, 14 years. So many people take that number as a good indication of the industrial, the United States industry is reviving, it's gaining momentum. So if, as you mentioned, that actually a small number of industries benefiting from the oil and gas boom in the United States, then where does the demand growth go to? Who is consuming most of the oil demand last year?
So if it's the energy-intensive industries that are the ones that will benefit. So the energy-intensive industries are also the ones that consume the most energy, right? So it's entirely possible that that you will see an increase in industrial energy demand because energy-intensive manufacturing has become more competitive in the U.S. That doesn't necessarily translate into an increase in overall manufacturing employment or output because the non-energy-intensive parts of U.S. manufacturing are probably likely to be less benefited.
Trevor, you made a comment at the beginning of the presentation before the discussion of manufacturing about the most important impact of this boom being the oil price future that it helped us avoid. What are the assumptions about Saudi production behavior that are embedded in that?
So obviously it's, as I said, it's difficult to say exactly what oil prices would have been absent the boom, though we were in a period of time where the Saudis were ramping up capacity pretty fast to deal with the loss of Iranian exports. So there was not enough GCC spare capacity to cover the 3 million barrels a day of U.S. Output. Also, prices historically start to respond even when Gulf spare capacity gets to relatively low levels, but not zero, because that's the buffer and the market gets nervous and people hoard inventory because there's not a lot of buffer left in the market. Other producers could have responded as well. I mean, if I had the ballpark, I think, crude oil prices in the kind of 10 to 15% higher range, maybe 20% higher over the past 5 years than they were. Much higher than that, demand would have collapsed and prices wouldn't have been very high at all.
It's worth a longer conversation. That's interesting. Yeah. Thanks.
Hey, Trevor. Russell Dyke from Morgan Stanley. I had a question about your comment early in the presentation that a decline in energy prices leads to a one-time boost in growth, but not a change in the rate of growth. I mean, it does seem like a lot of the decline in energy prices comes from new technology, fracking, which is basically allowing us to extract more oil and gas than we could previously. And also, the rest of the world is all trying to find out if they can copy that So let's say that the rest of the world found a way to use this new technology to unlock the oil and gas that's in China, in Argentina, in other places in the world, and overall global energy prices were lowered a lot. Would you still say that was a one-off change to global economic growth, or would that change the rate of economic growth?
It'd be a one-off, but it'd be a bigger one-off. It'd be a bigger one-off, right? I mean, in our analysis, energy prices decline, but only to a point, right? Like gas doesn't get cheaper than $3, right? Crude oil prices decline, but not indefinitely. If you had a perpetual decline in natural gas and oil prices, that's going to each year deliver an increase in the rate of economic growth, right? And certainly, if you had, there's not much downward room for natural gas prices, but there is considerable downward room for oil prices. So if you had a drop because of the application of fracking elsewhere in the world in global crude oil prices to 60 or to 50, then the economic impact in the U.S. would probably be 2x or 3x larger than what I had shown.
And what's the period that you measure that one-off drop? Have we seen the one-off pickup from lower oil and gas prices? Or
we are now, by in our analysis, it's between now and 2020 is when you overshoot a little bit and it comes back down, but it's a 40 basis points increase in growth in the beginning that kind of tapers down to a 10 basis points increase in growth in the optimistic case, right? But by 2020, potential GDP is 1.5%, 2%. You're kind of your rate of growth is about the same as the base case by 2020 in our analysis, but you hold on to those gains, so the level of GDP stays 1.5%, 2% higher after that. Okay. Of course, if you had after 2020 another reduction in oil prices, then that means potential output is going to go up a little bit higher than that.
Okay. You briefly mentioned your work in the UNFCCC negotiations at Copenhagen. How do you see this new play of domestic oil and gas production affecting the U.S.'s position in Paris in 2015, and then also global negotiations at large?
I think that it is for the U.S. position, it's beneficial because we showed up in Copenhagen saying we're going to deliver 17% with an asterisk next to it, which said contingent on legislation now pending before the U.S. Senate, basically, right? We had a hedge in there. That legislation failed. As long as the president's climate action plan is executed with decent force, we'll achieve that 17%, right? What that does for us in the next round is provides a level of credibility that otherwise would have been lacking. Because in the next round of negotiations, the U.S. is going to have to put forward a number, will be expected to put forward a number, and there will not be a specifically prescribed legislative pathway to get there. But what I would be able to say if I was still a U.S. negotiator is, look, politics are messy in every country, right? But we're serious about the commitments that we make. We made a commitment to 17% reduction by 2020. We didn't get there through our first best, but we ended up getting there at the end of the day.
But kind of by happenstance.
Well, it's a combination of happenstance and policy. The climate action plan, the executive actions under the climate action plan are necessary to get to that 17% number. If those don't get put in place, we'll be at maybe 8% below 2005 levels, maybe 4% below 2005 levels by 2020. But if we hadn't had the shale boom, we would be at maybe 1% below or 1% above by 2020.
And could you also briefly speak to how the changing dynamic in global energy prices might affect other global actors and their kind of take in climate negotiations?
I think the most direct impact is going to be in Europe, where you're already hearing from European industry protestations about ambitious post-2020 emission reduction commitments because of what it implies for European industrial competitiveness, and the kind of the line of reasoning goes, we're already on our back because of the shale boom in the U.S., and an aggressive post-2020 commitment in the EU will be the nail in the coffin. So I think that's where the shale boom is most likely to impact actual outcomes.
Okay, cool. Thank you.
Well, Trevor, this is extremely illuminating. Thank you very much, both for the presentation tonight, but for all the work that went into this extremely provocative and thoughtful book. And we look forward to further conversations. Thank you, everybody. Thanks for coming.
Thanks.